Hey now, you're an all-star. Get your game on, go play. Hey now, you're a rock star. Get the show on.
All right, we're back with the Big Money Big Daddy Show. Mark Conley speaking to you here on a Thursday afternoon, trying to create some value for you, helping you understand that there's serious questions you got to ask yourself. You got to ask your money manager if you want to have a successful investing experience, in, of course, my mathematical and humble opinion. But if you're not asking these or you're too chicken, I believe it's going to cost you. So I'm hoping you're not too chicken to ask the real questions. How do the markets work? How do markets work? Ask yourself, ask your money manager, ask yourself if you've defined your investment philosophy, ask the money manager what investment philosophy they've defined. Ask them how much money your portfolio can lose in any given time with a high degree of confidence. Can they explain that? Don't give me conservative, aggressive, moderate. That's meaningless. I want a number. Okay? Do you know how to measure diversification in your portfolio? Actually measure the correlation of different assets to see if they are linked in some way or to some degree. In other words, if real estate goes up, do stocks go up? If bonds go up, do stocks go up? How correlated are they? Are they measured mathematically? And just because something isn't correlated, though, I want to stress this, because sometimes I see these portfolios are like, I got a bunch of uncorrelated assets. Well, yeah, but if there's no expected return of the asset class, that doesn't mean it should be there either. I mean, the stock market and how well you do at blackjack, those are not correlated in any way, shape, or form. Okay, just stock market goes up, you may win or lose at blackjack. It has nothing to do with what the stock market does. That doesn't mean that blackjack is a good idea in your portfolio. There's a zero expected rate of return. See that with gold, commodities, things like that. So you got to measure it. Then I think everybody asks their money manager this: what's my rate of return? But what does it matter? What does a rate of return matter if it's not put in comparison to something else? Does it matter if the Rockets score 100 points? Well, only if it's more than Cleveland. That's the deal. So you really should quit saying, what's my rate of return? You should say, what's my rate of return and how does that compare to the market? Am I achieving market rates of return? The answer is probably not, but you need to ask that question. So how do you then move to the next question? What are the total amount of commissions and costs in your portfolio? Everything. And every time they give you a number, go, thank you. What else? Then they give you another number. Thank you. What else? Because see, what'll happen is you say, what's the cost of my portfolio? We charge 1% assets under management fee. Thank you. What else? The custodian, they've got a 50 basis points asset fee. Thank you. Is that it? Totally nothing else possible? Oh, well, we got some mutual funds in there. They got another 1.5%. You see where I'm going with this? Hadn't even gotten the trading costs. You know, if that mutual fund in there has a 1% fee expense ratio, but it's also got a 60% turnover rate, meaning if it had 1,000 stocks on January 1st, that they sell 600 of them by December 31st, you're going to lose some return on that. I'm here to tell you. There's a difference between the bid and the ask price, and you had a whole bunch of trading. It's a lot of little differences. They add up. So, that's a big question. And I think that even gets ignored. A lot of people that do the trading by themselves are like, I'm doing it by myself, no cost. It's not true. You're still buying ETFs or mutual funds. There's still a cost to them. There's still an expense ratio. There's still trading. And normally the biggest cost, people do it on their own, is the behavioral costs, because they tend to make a lot of mistakes. I do think it's interesting that so many people think they're more brilliant than people who do it 50 hours a week. But there's a lot of them. When it comes to investing, it seems like everybody knows what they're doing. Maybe it's kind of like golf is that way. Everybody seems to think they can play golf. They play golf. Everybody can play golf. But it's not true. But people get it with basketball. They know they cannot dunk a basketball. They get that. They leave that to the pros. But, hey, everybody's got an opinion. It is what it is. I just want to arm you with the questions that can make a big difference. So, next question. This one's kind of a strange one, but I'm going to throw it out there, and then I'll give you a little bit of information. Do you know where you fall on the Markowitz efficient frontier? This one I could probably take an entire segment, but here's quickly what I will say. There is a way, an evidence-based system of investing that uses math and science to calculate, once you know the returns of all the different asset classes, you know the risks as measured by standard deviation, you know the correlation, that's the diversification thing I was talking about, a way to put a certain percentage in each asset class to give the maximum expected return for a risk level that you are taking. And the question is, where does your portfolio fall? Most people have no idea. I can tell you that like the S&P 500, cheapest investment you can buy, it doesn't fall on the efficient frontier. It's very lacking. You should be getting better returns than that, or at least getting the same return with half the risk. It's one of the first things we do when someone comes in our office. We sit down, we run what's called a portfolio MRI, and we'll let them know where they fall on that efficient frontier. And if it's an inefficient portfolio, you might want to fix it before it's too late. All right. So this question's good. It's really good to ask your money manager. Do you know what you're building? Do you know what you're doing building your investment portfolio and why? It's kind of a little bit the same as do you know your investment philosophy? Maybe asked a different way, but how's it built? What are the pieces that are engineered in this portfolio, and why do we have these pieces, or why don't we have certain pieces? I kind of alluded a little bit earlier to commodities and things that have a zero expected return. Why would you have that in your portfolio? Just because it's not correlated with something doesn't mean we expect to get any return from it either. It may do good and it may do bad. It's a zero-sum game. Not what I want to build in my retirement portfolio. Do you think you're working with a financial coach versus a planner? I think this is an important question, and I'll explain the difference. So financial planner, and I'm a CFP, certified financial planner, been doing it 20 years. They're going to run numbers for you. And numbers are important, and they help you evaluate. You know, I just talked about building a portfolio the right way, all the math and science that goes in it to figure out a way to engineer a portfolio to give maximum return for an expected risk. Nothing, of course, is guaranteed. Okay, this is all using statistics and giving you a higher degree chance of success than your gut feeling. Okay? Well, that's great. But if someone can't motivate you to stick with the plan when it gets tough, because it always does, then all the numbers in the world are meaningless. I could give you a planning book that covered all the numbers on how you get premium returns, how you can measure risk and correlation and all that. And if you get scared about an election, make change your portfolio, it could be the beginning of constant change, and eventually you wake up and you're part of the Dow bar study. You got a 3 to 4% rate of return. Everybody got 9 or 10, or the markets did 9 or 10. I shouldn't say everybody. So a coach actually helps you do it. Okay. A diet is just a list of here's what you're going to do. A trainer makes sure you do it. I don't know about you, but I think having a coach matters. Why do football teams have coaches? Those football players know how to play football. They know they're good. Okay? They can get along with the other people. Not always, but many times. So, next question. Have you modeled out and created a lifelong game plan to make your decisions? Do you have an online way of putting all this stuff together? Your insurance, your investments, your retirement plan, your 401k, outside investments, all the things so that you can model out what you're doing. We do that for every one of our clients. Do you have an investment policy statement? Where is this investment philosophy, Mr. Money Manager, that you just told me we have written down? I'd like to read it. Huh. Love to see that answer. Do you have a clear-cut method for measuring success of your portfolio? Are you sticking with the if it's up, it's good, and if it's down, it's bad? You got to look at what the market's doing so you have a side-by-side comparison. So let's say earlier on I asked if you came up with a number of how you define what your risk level is, an actual number. Have you ever measured what your actual portfolio risk is? Because you may say 15% is the most I am willing to tolerate in the short-term downside, but then you look at your portfolio and it's built to go down as much as 40%. That'd be a problem. You've got to get those aligned with what you want and how it's actually being managed. I don't think a lot of people have ever done that. Do you know the 3 warning signs you're gambling your money versus prudently investing? Talk about them all the time. Stock picking. I know you did. You hired someone to pick stocks for you, or you pick stocks because you think it helps you. It hurts you. Standard & Poor's shows that only 20 to 30% of the time are you going to win. With those odds, do you think you'll keep doing it? The professional money managers don't. So I surely don't think it's going to happen for you. Stock picking doesn't work. Market timing, it's be in it when it's up, out of it when it's down. Look, if that was possible, that'd be great, right? It's not. Why do we keep trying? Can you start to identify what the media is out there talking about? And if the information helps you or hurts you or has an incentive behind it to sell you something, to scare you? Do you know people respond more to fear of loss than they do the excitement of good returns? And that's probably why everybody's returns are 3 to 4% and the market does 9 to 10 according to Dalbar. Everybody gets scared to death because there's a bunch of people to sell you all the stuff that scares you. Should you have some of your money in safe money? Absolutely, you should. You know, that's something you've got to do. But you don't need to be that scared that you don't even get returns from the money you have decided that you can put into equity markets. So I hope those questions can help you ask your money manager or ask yourself if you're your own money manager to start to make a difference. If you can get to where you answer yes to all those, it's our belief that you will have a fantastic investing experience. Even despite the ups and downs, you will mentally be prepared. And that brings me to the bop bang boom hard truth minute that only a good Big Daddy would tell you. Look, fears and concerns are real, okay? But if it didn't exist, those fears and concerns, the stock market would be more like bonds. It would pay very little. It's paid well because you don't know. You need to use capitalism in your favor. And it's our belief you'll get favorable returns in the market, or at least give you the best chance of it, of course, from a statistical standpoint. Because free markets work. Do you know how they do? If you don't, you need to find an advisor who can teach you. Flat out, there is a way to get premium returns, but hello there, it's not the way you think. Because stock picking, market timing, and track record investing is a terrible idea, in my mathematical and humble opinion. I want to appreciate everybody listening to the show. I think the information's great, but there is going to be even greater information. I'm going to dive into these questions that you need to be asking your money manager and asking yourself. I'm going to talk about how to reclaim your American dream. I'm going to talk about how to get your mind ready for the volatility battle that's happening and is going to continue to happen so that you are prepared and know when you hear information, when it's good information and when it's bad information, and how to take that and make it so it helps your portfolio. And I'm going to talk about all that on November 17th at 6:30 in the evening at Perry's. All you have to do is call right now, grab a seat, and hold on, and we will give you that info, because I have not found a firm like Wealth Design Group that is better at doing it. And I, myself, Mark Conley, will be presenting all this. So just give us a call at 713-826-0426, 713-826-0426, or you can text the keyword daddy to 72727. Text daddy to 72727. Do not forget to like us on the Big Money Big Daddy Facebook page, or email us at bmbd@wealthdesigngroup.net. Big Money Big Daddy.
I've had enough of scheming and messing around with jerks. My car is parked outside, I'm afraid it doesn't work. I'm looking for a partner, someone who gets things fixed. Ask yourself this question, do you want to be rich? I've got the brains, you've got the looks. Let's make lots of money. You've got the brawn, I've got the brain. Let's make lots of money. You got the brawn, you got the brain.
Hypothetical examples discussed are not intended to suggest a course of action or represent the performance of any product or security. All investments contain risk and may lose value. Past performance is not a guarantee of future results. Diversification does not guarantee profit or protect against market loss. Investing in foreign securities may involve heightened risk, including currency fluctuations, less liquid trading markets, greater price volatility, political and economic instability, less publicly available information, and changes in tax or currency laws. Such risk may be enhanced in the emerging markets. The S&P 500 index is generally considered representative of the stock market as a whole. It, however, focuses on the large cap segment of the U.S. market. Indexes are unmanaged and you cannot invest directly in an index. Wealth Design Group does not give tax or legal advice. Anything mentioned in the show related to these items is not advice, and you must check with your CPA or attorney prior to taking action. Securities, products, and advisory services offered through Park Avenue Securities, and member of FINRA SIPC.